How to avoid losing profits by ignoring market shifts. In the ever-changing investment landscape, the ability to respond to market shifts often means the difference between growing wealth and losing it. Ignoring these shifts can be one of the costliest mistakes seasoned investors make. In this educational video, we'll explore the importance of staying aware of market movements, how to recognize the early warning signs of change, and actionable steps you can take to protect and grow your portfolio. Whether it's a global event, technological innovation, or industry transformation, staying vigilant is your best strategy for long-term success. Let's dive into what market shifts are, why ignoring them is risky, and how you can position yourself to thrive in any market environment. Market shifts refer to the major changes in the economic or industrial landscape that can significantly impact investments. These shifts could be driven by advancements in technology, changes in government regulations, evolving consumer behaviors, or geopolitical events. They act like subtle undercurrents altering the course of industries, markets, and ultimately, portfolios. For example, think of the rapid rise of renewable energy disrupting traditional oil and gas sectors. Companies that diversified into green energy early benefited immensely, while those that hung onto fossil fuels exclusively found themselves struggling. Recognizing these market shifts is what separates savvy investors from those chasing outdated strategies. The decision to ignore or neglect a market shift can result in catastrophic consequences for your investments. Here's why. Missed opportunities. Failure to recognize emerging trends means losing out on promising investments. Companies at the forefront of innovation or sectors experiencing rapid growth are often where significant profits reside. Missing these opportunities reduces portfolio growth. 2. Eroding portfolio value. Industries that fail to adapt to shifts often decline. As an investor, holding on to companies or assets in these sectors could cause long-term losses. The rise of e-commerce, for example, sidelined traditional retail giants that resisted digital transformation. Heightened risk exposure. Shifting markets lead to increased volatility. Ignoring these changes leaves your portfolio vulnerable to economic shocks or industry collapses. One of the classic examples of ignoring a major market shift is Blockbuster versus Netflix. Blockbuster underestimated the shift toward digital video streaming, while Netflix embraced it fully. Blockbuster's reluctance to adapt led to its downfall, while Netflix soared, becoming a global entertainment powerhouse. Being aware of the subtle signs of market changes is essential. Here are some common early indicators to watch. Changes in consumer behavior. Consumer preferences often act as the first signal indicating market shifts. For instance, the shift toward eco-conscious products and sustainability started reshaping industries long before governments implemented stricter environmental regulations. If you notice consumers favoring certain trends, it's time to evaluate the potential impact on your investments. Economic indicators. Market shifts often align with changes in macroeconomic conditions. Watch indicators such as inflation rates, GDP shifts, interest rate hikes, or rising unemployment numbers. These can signal broader trends and warn of growth or contraction ahead. 3. Industry-specific disruptions. Examine disruptors in specific sectors where you have investments. For example, the rise of electric vehicles revolutionized the automobile industry, leaving legacy car manufacturers scrambling to adapt. Staying tuned into disruptors can help you act before industry giants lose ground. 4. Emerging technologies. Innovations such as artificial intelligence, blockchain, and biotechnology are not just buzzwords. They represent profound transformations in economic landscapes. Understanding the implications of emerging technologies helps investors allocate resources to industries with promising futures. Once you recognize that a market shift is occurring, the next step is to activate your defense and strategy mechanisms. Here's how to stay ahead of the curve. Monitor data consistently. Use reliable financial tools and platforms that provide insights into market trends and data. Trend analysis should be a regular activity, not just something you glance at during portfolio reviews. 2. Diversify your portfolio. Ensure that your investments span multiple sectors, industries, and asset classes. Diversification acts as a buffer to market volatility, ensuring the impact of a downturn in one sector is cushioned by stability in another. 3. Focus on growth areas. Identify sectors poised for expansion and allocate a portion of your portfolio to these areas. This proactive approach not only mitigates risk, but positions you for aggressive growth. Renewable energy, Technological innovation and green finance are prime examples of areas that benefited early adopters. 4. Timing market entry and exit. Acting on market shifts requires finesse. It's not just about recognizing change, but about executing timely market entry and exit strategies. Adjust your holdings before the shift peaks and consider pulling out of declining sectors in anticipation of a downturn. In the digital age, staying ahead as an investor means leveraging technology and resources for up-to-date market insights. Some useful tools include market analysis reports. Regularly review detailed reports that dive into global economic indicators, industry-specific trends, and competitive landscapes. These provide invaluable insights into possible changes ahead. Global event monitoring. World events, especially those with political, environmental, or technological implications, often drive market change. A simple example is how global unrest or oil price wars impact energy stocks. Pay close attention to news and forecasts. 3. Investment screening tools. Use software systems that parse through large data sets to identify growth areas or industries on the brink of expansion. Many platforms now include artificial intelligence for predicting market trends. 4. Regular portfolio audits. Periodically assess your portfolio's alignment with current market conditions. Conducting self-audits ensures your holdings are not disproportionately exposed to industries at risk due to shifts. For seasoned investors already familiar with the basics, the key lies in optimizing application. Here are steps to internalize and implement. Conduct a portfolio vulnerability audit. Examine all investments to identify areas overexposed to specific sectors susceptible to negative market changes. Make adjustments accordingly. Prioritize leading indicators. While lagging indicators may confirm past performance, leading indicators like economic forecasts, emerging industries, and new product launches provide forward-looking guidance. Stay several moves ahead by focusing on predictive data. 3. Learn from adapting leaders. Study companies or industries that have successfully pivoted in response to past shifts. For example, companies like Tesla revolutionized their industry by committing early to electric vehicles and renewable energy. 4. Regularly adjust strategies. Markets don't remain static, and neither should your investment tactics. Plan to revisit your strategies every quarter, or whenever major economic or global events occur. Kodak is another cautionary tale of ignoring market shifts. Despite pioneering digital photography technology, Kodak failed to adapt its business strategy to the growing digital trend, focusing instead on traditional film cameras. This refusal to adjust led to a decline in its market dominance, opening the door for competitors like Sony and Canon. In an investment world shaped by constant change, recognizing and reacting to market shifts is not just a skill, it's a necessity. As a seasoned investor, you've already mastered many investment strategies. Now, apply those skills to identify and adapt to evolving trends that threaten or reveal potential. To recap, stay proactive by monitoring market signals, diversifying your portfolio, and entering or exiting markets at the right time. Leverage advanced tools to stay informed and focus on leading indicators for decision-making. Remember, evolution is essential not just for companies but for investors too. Finally, commit to continual learning. Markets evolve quickly, and those unwilling to adapt often lose out. Stay vigilant, stay dynamic, and ensure your portfolio grows with the markets, not against them. Thank you for watching, and here's to smarter, more strategic investing.